Ray Dalio out with a brand new interview a few days ago. I've been wanting to react to this one the last several days with you guys. We're going to finally do it here today. Ray Dalio speaking about several different important subjects. Obviously, many people look at Dalio as an investing legend in the market, and obviously he's one of the richest people in the world. So I want to react to that one, kind of give my opinions and perspectives there. Second video I want to react to is Cam. Cam's out here talking about the stock market being overbought, what she's kind of expecting to happen in the market, her perspectives and opinions, and I'll kind of share my perspectives and opinions based upon that. And then the last one we'll react to is Jim Liebenthal and these other gentlemen talking about economic slowdown. And if we did have that, like, what are we talking about here? A small recession, a mid-recession, a big recession? Is this something that would even affect the market in any substantial way? So many other various things. Appreciate y'all joining me as always. Thanks so much for being here. Losing my voice a little bit. So I apologize if I'm a little quiet today, but hey, it's not always a bad thing, right? One day, folks. 1 day, 9 hours away from the Black Friday deal. It's once a year deal. Pin comment down there. Make sure you get access to this. Become a Master Stock Market course. That takes about 3 weeks to usually go through that for the average person. Plus, you get the ability to see the moves I'm making in the market, to see exactly how I diversify my portfolio, plus be part of the Discord chat. Make sure you get part of that deal. Okay, that's pin comment down there, so your last chance to get in there for that one. Alrighty, guys, let's get into this.
You said that the United States, you think, will be facing a debt crisis. The yields have changed pretty dramatically just in the last week or so. You still think that that's the case?
Yeah, it's look. You have a change of 50, 25 basis points and so on. Let's just go back to the basics and the big picture. First of all, let's take the bond yield. The bond yield, roughly speaking, has got to be about what we determine the expected inflation rate will be over the period of time. There's a question about that. That number probably is settling into the vicinity of 3.5%. That's the right number. There has to be, above that, a real interest rate. In other words, for those who are holding debt assets, they have to receive a return above the inflation rate by something probably in the vicinity of 1.5%, 2%. So that is going to get you in the vicinity of 4.5%, 5% interest rates. And you're seeing the movement around that level. Then there's the big question of the supply demand for bonds. In other words, the government produces a certain amount of bonds that are in size that is equivalent of roughly the size of the deficit. That means they're going to have to sell a lot of bonds, okay? And then we look at who are the buyers of those bonds and do they have an adequate appetite. And that's a big risk because we have many who own those bonds have had losses in that. That's not just banks, that is central banks, that is Japanese investors and so on. And so there's a supply-demand issue. You'll have these wiggles around there, but those are the fundamentals that will drive it. So as we look forward, we have a debt problem because you can't keep adding to debt faster than you add to income without that problem. So we're seeing the need for the rise in real interest rates so that the creditor gets an adequate return at the same time as we have a supply-demand balance. So that's how it looks to me. What's happening in the economy is that a lot of money was sent out.
Ray Dalio cracks me up because, he's explaining this to somebody like they're five or they have Ray Dalio doesn't, I don't think, realize he's on CNBC right now, and like 98% of the people watching CNBC know these simple basics on how these markets work. But anyways, he's obviously made some very popular YouTube videos over time, and for that general audience, like, I understand you got to explain more of what's going on here, but yeah, anyways.
Checks and the like, and went out to a lot of people, and so there was the household sector did well because the government sector did poorly. They got themselves in deeper debt intentionally so that the household sector and the business sector could be better off. And then there's the rise in interest rates. What happens from that is that savings of money gradually goes down, and also the debt maturities, as they roll forward, gradually go up and create a squeeze. So there's an emerging squeeze happening. However, because the unemployment rate is relatively low, and because the compensation levels have been relatively high because of that set of circumstances, the household sector's income has been good. So you have a sector in the household sector, hence the economy as a whole, and I'll include the business sector in that, in which, by and large, the financial transfer of wealth from the government as it got in debt and gave it to the public sector, gave it to the private sector, that allowed that to happen. So that is a formula in a punchline. I'm sorry, I'm taking too long. That is a formula for a gradually weakening economy, not a big break in the economy, a slowing of that economy. I think that's what we're seeing. And as a result of that, that's what you're seeing in the bond market, as there's a bit of a easing within that range.
Play this out.
Okay, so that's a big statement Ray Dalio just made right there. Very big statement. He's basically saying that we have a gradually slowing economy. Not off a cliff type situation, but a gradually slowing economy. I think that's a very big statement by him, because he could have definitely took that a different direction.
Play this out a little bit longer, which is to say, where do you think interest rates are a year from now, on a very just straight up basis? But then even longer than that, you're talking about the debt problem that we have in this country. That's becoming a main feature of debate and a topic, of course, in the presidential election, and what's going to happen come November 2024 and beyond.
I don't think it's going to be a big debate. I don't think it's going to be a big debate in the election cycle. Especially if it's T-man versus B-man, it's not going to be a big debate. Why? I'll tell you why. Debt went up massively under T-man. It went up massively under B-man. Neither one of those guys kept debt in check at all. And so I don't think it's actually going to be a conversation. Unless T-man's not the one to represent his side. Then we're talking about a different situation. But neither one really has ground to stand on in this situation, because just factually, under both of them, debt levels went up substantially.
As far as the question of where the rates are, I think that most likely, I think the rate structure is going to be staying at its level, perhaps slightly less, but there's a range of uncertainty around that, having to do with the supply-demand question. We're now at a period of time where the supply of bonds to be sold will start hitting the market. And now we have to see the demand issues of that, and that'll be around there. I think that probably in the vicinity of, I would say somewhere in the vicinity of relatively flat. I don't think there's going to be any important change in the Fed policy other than maybe a slight easing as the economy slows down. I think the thing to realize is that the economy will likely weaken. In other words, its growth rate going to something close to zero, plus or minus, maybe 1%. And with that exerts a slight downward pressure on interest rates. At the same time, the supply issue becomes an important issue. The second part of your question, I forgot the second part. What was that?
Well, just how much, I think
the
longer-term damage of having these having this enormous amount of debt. Obviously, that's playing into the political debate. But if one, it sounds to me you're also arguing that if we're going to have a soft landing, that maybe people are going to feel more comfortable holding as much debt as we do, and that the rates are not going to, blow through the roof.
No, I think we're talking about the short term as very distinct from the longer term. The short term we just talked about. The longer term is that we are at a point in which we are borrowing money to pay debt service. And there is a process by which when you keep having debt growth faster than income growth, then that means that you have debt service encroaching on your spending. That's the same for the government as it is for us. And as that happens, and you want to keep spending at the same level, there is the need to get more and more into debt. And the way that works, it's like it accelerates. We are at the point of that acceleration, which creates the supply-demand problem. And it's made worse by the other issues that we're talking about. The internal political issue, the internal social conflict issue there is something that is affecting foreign demand for bonds. For about 40% of our debt is sold to foreigners. And so there is a concern of the American politics, of the controlling of this debt crisis, and these types of things. So we come back to the same basic question. How strong are we going to be? When we talk about strong, what I mean is also economically strong. And economically strong means financially strong. That means it's just a basic thing. Financially strong means, do you earn more than you spend? And do you have a good income statement as a country? Do we have a good income statement? And do we have a good balance sheet? More assets than we have liabilities. The worse that gets, the more we are going to have that long-term problem. And it's just, you can see it in the numbers. It's just a matter of numbers. We are near that inflection point.
Okay, so two things I want to cap off there with the Ray Dalio. The first one is, I'm actually pretty surprised he even did this interview. And the reason being is, like, he's not in charge of Bridgewater anymore at this point in time, so I don't even know why he did the interview unless he just wants to share his perspective, or it could be there was a pretty, I would say, negative book put out in the past couple of weeks in regards to Ray Dalio. I'm trying to remember who wrote the book. I can't remember who wrote the book, but somebody wrote a pretty negative book on him recently. So I don't know if maybe it was like a publicity thing to like kind of get him out there talking about the markets. I just thought it was weird. I'm like, wow, Ray Dalio just, he's not the guy leading Bridgewater anymore, or really much to do in there anymore. So I thought that was pretty interesting. But I think the other important part is, clearly Ray Dalio is not necessarily calling for a crash or some end of the world recession or whatever. He's very measured in kind of his approach. He thinks we're in a gradually slowing economy right now, and that's kind of that, right? And if the economy continues to slow over the next 6 to 12 months, eventually the Fed will be put in a position where they'll end up starting to cut rates at that point in time, especially if inflation's not an issue, which inflation won't be an issue in 2024. So that was pretty intriguing interview there by Ray Dalio. I appreciate him being out there and sharing his thoughts. Okay, next one up here, Cam. The stock market is overbought right now. What you get to say here, Cam?
Trying to figure out what you think is the most important right now. Is it the Fed minutes that we heard? Is it what we've seen with earnings and maybe NVIDIA's disappointment? Is it some of the broader stories with crypto? What do you think is most important right now?
We didn't see much market reaction out of the Fed minutes yesterday. We thought that we might see a little bit more, at least in the long end of the curve. There was a really important phrase in there where they talked about how that even if they were going to be cutting rates, that they might still continue QT, which in theory, that would keep upward pressure on rates going into next year. Then really we'll turn to the December meeting, because that's where we think it's more important for the outlook for rates into 2024, because we get an update to the dot plot. And right now the dot plot only has 25 basis points of cuts priced into it. That compares to the 100 basis points that's in the market, in the bond market. So that's a pretty wide gap. We'll have to be watching closely to see if that gap closes.
What do you think about the rally we've seen to this point in equities, just based on what's happened with yields coming down?
Yeah, certainly that's been the kind of wind beneath equities' wings to have yields moving down. We also know that we have these seasonal dynamics, and I think it's really important to note how different they are versus last year. Just because last year, the largest weights in the index were down a lot, so they were big tax loss selling candidates. Yep. This year, the largest weights in the index are up a lot, which means that people probably are not really wanting to recognize tax gains into the end of the year.
Which also means when are some people are likely to take some profits in regards to big tech companies and a lot of these big stocks that have done very well this year. They're likely going to take some of those gains in the first quarter of 2024. That's a probability, a high probability that there will be some level of profit taken, and probably a pretty decent level of profit taken in a lot of those big techs, especially if Santa comes to town in December and we roll for December as well. High probability. By the way, let me check in on the market. I want to see how my stocks are doing here today overall. All right, let's see what's going on out there. So Honest is honestly going crazy right now. Honest is just being a freaking beast, man. That stock is on a roll, 51% in a 1 month. Amazon's my second best stock today. Interesting. Cake, Avant, PayPal, Elf on a Shelf, Mattel, Shopify, Meta, Skyworks, Texas Roadhouse, Revolve, Wynn Resorts, Qualcomm, JP Morgan, Pfizer, all green. And then we got Target, Palantir, Fubo, Foot Locker, Tesla, JWN, and The Planet as the Red Dead Redemptions out there today. So overall, pretty good day. Not the best day in the world, but we'll take it. It should be a in the green day. Let's just call it that.
Have things like window chasing or window dressing and positioning chases.
Yes,
it's probably why we're seeing so much strength. And then we'll have to really assess where we stand on things like positioning and sentiment and valuation once we roll into 2024.
Yeah, that's what I was going to say. Do you buy this at this point? Is this a time where you would say we'll step in even with the gains we've seen? Do you think the run continues, or are you worried about a pullback at some point?
Well, I do think that we are overbought right now. So in a very short period of time, respecting the fact that you've moved up very far, very fast, being overbought isn't necessarily a bad thing in the medium term. It can sometimes be a sign that people are just clamoring to get into the market. But I think over the very short period, having some digestion does make sense. But I think if you're looking to buy into this market, it really depends on your time frame. In a short period of time through the end of the year, maybe you do have those seasonal dynamics that lift, but then you have to remain disciplined to say, where are expectations? Is everybody already on the same side of the boat, expecting a very strong market into 24? And then at that point, you might get a better chance to add to positions if you are underweight.
Yeah, I think the first quarter and second quarter of 2024 could be actually interesting buying opportunities in some of the bigger companies specifically, right? Obviously, right now, I think it's been a tremendous time, over this past few months to start buying dividend stocks, a lot of small caps, things like that, right? And a few growth here and there. But I think if I looked out to the first quarter, second quarter of next year, I think it could be really interesting potential time to be a buyer of some of the big dogs, because I think there's a pretty decent probability some of those big dogs could be in a tougher place in the first quarter and second quarter because of all the momentum they've had. And I think there's going to want to be a lot of profit taking. I just really do, right? And then you'll have all the new worries about the economy and all those sorts of things that will obviously, everybody will start talking about again. Now we're in kind of the holiday season, so that's going to take a little bit of a back burner. But then come January, February, everybody's going to be talking about, this is going to happen, that's going to happen, unemployment, all these sorts of things, okay? Next one up here, potential economic slowdown is likely to be short and sweet.
Just since you referenced it, Lori Calvasina from RBC out with a 5,000 target for the S&P for next year. Just want to mention it because you talked about it. But I want to say
5,000 price target for next year? If we don't have a recession, it's accurate. If we don't have a recession, 5K. It's in
current situation right now.
Probably going to happen.
What's your take on what you're seeing? Again, we saw bond yield.
So S&P at 5,000 by year end, 2024. And I mean, if we don't have a recession, we could approach above 5,000. Sentiment setup is constructive. Valuations can stay higher than many realize. Small caps intriguing. Heck yeah.
To a 2-month low, 4.36, bouncing back up like a
They've been intriguing for 2 years.
I feel like a lot of people I talk to want me to get worried about the situation. Now, I really appreciate the positivity from my colleagues, but a lot of people want to talk to me again about the yield curve. Like, honestly, I think I'm done talking about the yield curve. Let's just leave that aside. Or they want to talk about durable goods orders disappointing today, or maybe Deere's guidance, which we'll get to later, or Cisco's guidance last week. And I really think the point is being missed both in the microscopic and the big picture. The microscopic, let's just do that right now. Jobless claims. We were supposed to get worried last week when they popped, and now they're right back down to where they've been hanging out, right around 200,000. And that is very important, folks. If people are employed, they're going to consume. Consumption is 70% of this economy. I get it about consumer delinquencies. I get it, about running out of savings. But here's the bigger point, is that let's just say I'm wrong. Let's dance with this idea for a second. Joe got very excited there. It's like he's going to dance with me on this. No,
I'm actually very calm, but
your eyebrows raised. For you, that's very exciting.
I'm trying to stay awake while you're talking.
Let's take it down a notch, guys.
Oh, damn. This is why you don't try to banter or argue back and forth with some East Coast folks, man. They got comebacks for days. They got freaking comebacks for days, these East Coast people. That's all I got to say. Boston, Philly, New York, man, you don't argue with those guys or try to go back and forth because I'm telling you, they got 10 comebacks ready for you at all times. It's a different breed. It's a different breed up there, man.
That was good. Let's just say that I'm wrong and that there is a slowdown that's occurring right now that's bigger than I expected. Let's just say I'm wrong about the economy skating through there. You know, it is likely to be short and sweet if there's a slowdown. These guidances that we haven't liked, I mean, the fact that next year's earnings estimates have come down as the third quarter results have gone up.
Barely.
Okay, but they certainly haven't integrated the excellent third quarter results. Look, people are still thinking this is going to be some clear the forest floor fire. But all the imbalances are out, right? All the crypto, NFT, meme, SPAC stuff, that was done 2 years ago. You don't have a housing boom. You don't have a tech telecom boom. There's no overgrowth in terms of investment that needs to be cleared out with some brutal recession. So
Jim,
if we're in that slowdown, Frank,
right?
We're in that slowdown
that you're not
right
worried
now,
about, to be clear.
It's likely to be done really quickly.
Yeah, we are getting.
Okay. I'll have to take the bearish stance in this one, okay? We could have said that same thing going into the great financial crisis, right? Could have said the same thing. Like, if you look at the stock market did not seem like it was in some sort of big bubble or anything like that. Obviously, crypto wasn't even around back then. NFTs and things like that weren't even around back then. People looked at the real estate market and thought it was just fine, and obviously it wasn't fine, and we had huge damage to come. So, to push back against that, you can still have a lot of problems even if it doesn't look like a problem at that moment.
Third quarter GDP next week, so that's something to watch. You mentioned the slowdown. We'll talk about it a little bit later in the show. But Joe, I know you want to jump. You're trying to stay awake while Jim's talking. I just wanted to come off your one-liner. That was a good liner.
No, but I think the premise that you have is that the fundamentals of the economy are strong, but I'm not sure that's the catalyst behind why the market's rallying right now. It's buying you. And I think, I think when you turn the calendar into January, I don't know if that is going to be the thesis that the economy is overwhelmingly strong and we could take the handoff from a nice Q4 rally into Q1 of next year. I think it has to be that the Federal Reserve sits with their hands, doing nothing, and that the economy shows the signs that it's showing right now, Jimmy, where I disagree with you somewhat, where yes, in fact, the consumer is more cost conscious. And in fact, it does look like we're seeing a little bit of deceleration in the economy. And I think that's a good thing.
Yeah, 100%. Okay. Appreciate everybody joining me as always. Thanks so much for being here, folks. Thanks for being subscribed. Last chance to get in if you want that Black Friday sale, $62, access to my #1 stock market course ever, as well as ability to see the moves I'm making in the market. That's pinned comment down there. Enter in your info. It's a 1 day and 1 day only sale. We'll send it over either via text or email on Black Friday. That'll be one chance to get it. Much love and have a great day.